Have you been in escrow where everything seems fine? The buyer looked approved, the transaction felt smooth, and suddenly you got a call that changed everything. The lender said the rate changed, the loan terms changed, the buyer no longer qualifies the same way. The payment went up, or the lender needs more time. As the seller, you're sitting there thinking, what just happened? We already accepted the offer, we're already deep into escrow, and we are already planning the move. So how can the lender change things now? Hi, my name is Rima Rafeh with the Rafeh Group with the XP Realty in Santa Cruz Valley and covering Los Angeles County. We're gonna talk today about the most stressful surprises that can happen mid-transaction. And the reason it feels so scary is because most sellers don't understand how much power lenders have during escrow. So today I'm going to break down exactly what it means when buyer's lender changes the terms mid-escrow, why it happens, how it affects you as the seller, and what your options are and how you can protect yourself so you don't lose time, money, or leverage. So let's start with the biggest misconceptions sellers have. Most sellers believe that once the buyer is pre-approved, financing is basically locked. They assume the buyer is solid and they assume the loan is done. And then they assume that escrow is just paperwork and waiting. But financing is not final until the very end of escrow. A buyer can be pre-approved and still face changes. And buyer can even be conditionally approved and still face changes, because lenders do not fully commit until underwriting is complete and all conditions are carefully met. So the first thing sellers need to understand is that escrow is not just a countdown to closing. Escrow is a verification process and the lenders are verifying everything all the way through. Sellers often feel like once the offer is signed, the hardest part is over. But in reality, the hardest part can sometimes be the buyer's loan journey from contract to funding. Now, what does that mean when the lender changes terms? It can mean the interest rate changed, the down payment requirement changed, the loan program changed, or the buyer's approval amount changed, or the lender discovers something new during underwriting. Sellers often hear this and feel like the lender is being unpredictable or unfair. But lenders operate under strict risk rules and they adjust terms when new information surfaces or when market conditions shift. Let's talk about the common reasons lenders change terms mid-escrow, and that is interest rate. Rates can improve daily, and if a buyer has not locked the rate, their payment can change dramatically during escrow. A buyer might write an offer assuming a certain payment, and then rates rise. Now the monthly payment is higher. Now the buyer's debt-to-income ratio changes, and now the buyer may qualify differently. And suddenly the lender says the buyer needs to bring more cash, reduce debt, or adjust the loan structure. This is one of the most common mid-escrow surprises sellers experience, especially in volatile rate periods. Sellers need to understand, but buyers do not control interest rates. A buyer can perfectly qualify at one rate and borderline qualified at another. This is why rate locks matter so much. When buyers fail to lock early, sellers become vulnerable to market volatility even though the home itself did nothing wrong. Now, another reason term change is underwriting discovery. Underwriting is where lenders dig deep, and this is when they verify income, employment, bank statements, deposits, debts, and credits history. Sometimes underwriting discovers issues the buyer did not anticipate. Maybe the buyer is self-employed and the income calculation comes in lower than expected. Or maybe overtime or bonuses cannot be counted. Or maybe a large deposit needs explanation. Or maybe a new debt appears. Or maybe the buyer financed a car during escrow. or open a new credit card. These things happen more often than the sellers realize. And when they happen, lenders adjust terms because they need to reduce risk. This is why sellers should understand that financing is not just about the buyer being a nice person who wants the home. Financing is math, underwriting guidelines, and risk tolerance. It's a system that does not bend for emotion. Now let's talk about the escrow timeline, because this is where sellers get caught off guard. Week 1 of escrow often feels exciting. The buyer's motivated, inspections are scheduled, paperwork begins, and sellers feel momentum. But the loan process is only the beginning. The buyer submits documents, the lender orders appraisal, underwriting begins review, and conditions start forming. Week 2 and 3 are where lenders start asking questions. This is when sellers might hear the lenders need more pay stubs, the lenders needs explanation of deposits, the lender needs updated statement, the lender needs verification of employment. Sellers often don't hear all of this directly, but affects the timeline. Now, week 3 and 4, where appraisal results arrive, if appraisal is low, terms may change instantly. The lender reduced loan amount and the buyer need more cash. The buyer may ask for the seller to reduce price or provide credit. This is one of the biggest turning points in escrow process. Week 4 and beyond is where final underwriting and clear to close happens. This is where lenders double check everything again, even employment, because buyers can lose jobs or change financial status even late. Sellers are often shocked that lenders verify until the last minute, but they do because lenders are funding hundreds of thousands or millions of dollars and must reduce risk. Now, as a seller, what this means for you? It means the timeline could change, closing could be delayed, and the buyer could request an extension, and the buyer could come back asking for concessions. And in some cases, if financing truly falls apart, the buyer could cancel. This is why lender changes are not just buyer problems. They directly affect sellers. Sellers are planning moves, coordinating purchases, scheduling life changes, and lender disruptions create chaos. Now let's talk about the most frustrating part for sellers. The buyer might come back and ask for help. They might ask for closing cost credits, they might ask for rate buydown, or they might even ask for price reduction. Sellers feel blindsided, but from the buyer's side, they are often trying to keep the deal alive. This is where seller strategy matters, because not every request is unreasonable, and not every request should be accepted either. A smart seller asks, is this a true financing gap, or this is a negotiation leverage? A strong agent helps determine whether the lender truly requires this adjustment or whether the buyer is using uncertainty to ask for more. Now, let's talk about extensions, because lenders changing terms often leads to extension requests. Sellers need to know that extensions are not automatically bad. Sometimes lenders simply need more time to clear conditions, but extensions must be managed strategically, because every extension costs sellers time, holding costs, and opportunity. Sellers should ask how long is the extension for, what's the reason, and what documentation proves progress, and what happens if the buyer still cannot close. Extensions should not be open-ended, they should be structured. Now let's talk about seller leverage, because mid-escrow, lender changes often shift leverage. Early in escrow, sellers still have momentum. Late in escrow, sellers feel committed. Buyers know sellers don't want to restart, which is why seller must stay emotionally steady and strategic. You always have options. You can negotiate, you can hold firm, you can agree to reasonable concessions, or you can cancel if the buyer cannot perform. Now, contingencies are critical. Most buyers have a long contingency. Until that long contingency is removed, the buyer has an exit door. If financing changes dramatically, the buyer can potentially cancel. Once contingencies are removed, the buyer's risk increases and the seller's leverage increases. Sellers must know exactly where they are in the contingency timeline when lender changes happen. Now let's talk about how sellers can protect themselves upfront. The best protection is choosing the strongest buyer at the start, not just the highest offer. Strong financing matters and strong lenders matter. Large reserve matter and short loan contingencies do matter. And responsive communication matters. Sellers should evaluate lender reputation the same way they evaluate the offer price. Now let's talk about lender quality again, because lender reputation matters more than sellers think. A strong lender closes on time. A weak lender creates chaos. A strong lender communicates early. A weak lender surprises late. Sellers should always ask who the lender is, whether they are local, they're reputable, and whether they have track record of closing on time. Now, what happens if the buyer lender changes term? The deal is at risk. The first thing is communication. Your agent should be immediately get clarity. What changed? Why did it change? Is it solvable? And how long will it take? And what does the lender need? Then sellers can evaluate calmly. Is an extension reasonable? Is a small credit worth having or saving the deal? Is the buyer still strong? Or this is the beginning of a collapse? Experience matter here because sellers need to avoid emotional decisions. The bottom line is this: lender changes mid-escrow are stressful, but they are not always disasters. Many deals still close successfully after adjustments. Sellers must understand that financing is not final until closing. And the best way to protect yourself is to choose strong buyers, choose strong lenders, and track contingencies carefully. Stay strategic and have an agent who knows how to navigate lender curveballs. Because at the end of the day, the deal that closes is the deal that matters. If you are selling or thinking of selling and want guidance through escrow financing issues and buyer negotiations, I would love to help. I'm Rima Rafeh with eXp Realty, and thank you for watching, and we'll see you on the next video.